Lattice Semiconductor has climbed over 130% in the last year, fueling a wave of optimism across Wall Street. With analysts setting a $148 price target, the momentum appears unstoppable. But the financial reports reveal a widening gap between the stock's performance and the company's actual output. Beneath this upward curve, the core metrics suggest a business that is decoupling from its market price. The trailing price-to-earnings ratio has reached a staggering 888. At this level, an investor is paying $888 for every $1 of past profit, a valuation that towers over the industry average of 35. The price-to-sales ratio exceeds 30, nearly 5 times the sector average. Based on estimated intrinsic value, the stock is currently trading at a 98. While the stock price climbed, the business actually shrank. Since its 2023 peak, Lattice saw a 30% decline in total revenue. On remaining revenue, margins are thin. For every $100 brought in, it keeps just $3.46 as profit. To understand the impact of these shrinking numbers, we must examine the return on invested capital. This measures how effectively a company generates profit from the money it spends on its own growth. Lattice's capital cost is 14%, but ROIC is just 3.24%, earning 1/5 of its deployment cost. The trend is accelerating. Return on new capital over the last year is negative 196%. Every new dollar put to work results in a net loss. When a company's top-line revenue is falling, while its capital efficiency turns negative, the growth story is no longer supported by the balance sheet. This raises a question. If the underlying business is contracting, why hasn't the market felt the drop in demand? Lattice moves nearly 90% of products through a few distributors, recording revenue upon shipment, not final sale. This creates a whipsaw effect. Distributors build inventory, making sales look strong on paper, even if end users are starting to pull back. When those distributors eventually realize the stock isn't moving, they stop ordering entirely to clear their warehouses. At that point, the true drop in consumer demand hits Lattice's financials all at once. Because so much volume is concentrated in these intermediaries, the company is effectively insulated from the reality of the consumer market until the correction becomes unavoidable. Financial metrics provide one perspective, but the actions of the people running the company provide another. Recently, Lattice insiders executed 20 separate sales and 0 purchases. The CEO and senior vice presidents are reducing their positions. Total insider ownership has dropped below 1%. Leadership now holds a smaller stake in the company than the institutional investors buying the stock. This lack of insider conviction follows a long history of severe regulatory friction. The company previously restated earnings due to accounting errors and faced SEC fines for failing to disclose insider trades on time. Against this backdrop of shrinking revenue and insider selling, Lattice recently announced a $1.65 billion acquisition of AMI. To pay for it, they are taking on over $1 billion in new debt. They are doubling down on an acquisition strategy while current returns are deeply negative. When insiders move to the sidelines while loading the balance sheet with massive debt, they shift the financial risk entirely onto the public shareholders. When we combine these factors, the 888x valuation, the negative capital returns, and the mass exit of insiders, a specific profile emerges. At these price points, the buyer is paying for a software-style growth story that the underlying hardware business has yet to deliver. A market can remain detached from reality for a long time, but the fundamentals eventually dictate the outcome. Recognizing the signs of an overvalued position requires looking past the daily ticker. Do your own research, examine the efficiency of the capital, and always watch for the red flags hiding in plain sight.